Hello everybody, this is Tortoise Investing coming at you today with a 5 dividend stocks that you can buy and hold forever. If you enjoy videos like that, I primarily do those usually 2 to 3 times a week. So if you could please hit that subscribe button. It's super duper free and super duper easy to do. Let's grow the channel and our portfolios together. I greatly appreciate all the support. Now without further ado, let's go ahead and take a look at the 5 stocks we're going to be looking at today. All of this is for entertainment and educational purposes only. Don't take any of this as financial advice. Just want you to see some stocks that I think might be on sale. So we got MSCI. MSCI has a free cash flow yield of 2.63%, a dividend yield of 1.19%, and a payout ratio of 45%. The thing I really like about this company is its continuous growth and just how quickly it's growing. So MSCI was at a recent high as of February of $562, now down to $466, almost down $100 off its recent highs. I liked it. It's in my portfolio. Its revenue growth over the last 5 years has been growing at a rate of 12.03%. The free cash flow has been increasing at a rate of 23.54%. Absolutely love that. Free cash flow is one of the main things I look at when investing in any company. EPS has been increasing also 26.26%. Very quick, and that dividend's right in line with the free cash flow. 29.43% increase in the dividend. That is crazy. I love it. Shares over the last 5 years have been decreasing at a rate of 2.44%. So they are doing share buybacks, and you always love it when a company is doing share buybacks. Doing share buybacks with an increase of that dividend that quickly is amazing. And the return on capital employed is increasing. Been above 20% for a while. There's just a lot of things ticking in the right direction for this company. I like it. It's the biggest holding in my portfolio currently. Next up, we got Northern Grown Corp. Probably said that wrong. Anyways, free cash flow yield of 1.58%. A little bit low, but still not too bad. It's not in the single digits. Dividend yields 1.67%. It's got a payout ratio of 21.88%. They are down year to date 16.3%, as you see here, off the recent highs of 540. So they're down to 452. So similar story to MSCI, down about $100. Their revenue over the last 5 years has been increasing at 7.24%. The free cash flow is a little bit, it's kind of like all over the place. But if you do a regression line here, it is up and to the right. So it is slowly increasing over time. EPS over the last 5 years, 22.31%. They've had this recent spike here the last 2 years. They're getting things in order. They are figuring things out. You always like to see that. The dividend has been increasing at a rate of 9.28% over the last 5 years. So right there in line with a 10% increaser. Great compounding. The shares outstanding have been decreasing at a rate of 4.76% over the last 10 years. So they are doing share buybacks. Again, I love to see this. I love a company that is buying back their shares on top of dividend increases. It means they're doing things right. They got things figured out. The return on capital employed is also increasing, which is another plus. You love to see that with a company. I didn't go over the debt of MSCI. I'm dumb. Sorry. $4.5 billion in debt. Their EBITDA is $1.33 billion. I don't really view that as too big of an issue. I usually try to keep debt at a 3. I don't like to have debt to be 3 times more than EBITDA, but with MSCI, I do make a small exception. So Norfolk, we got 11.81 billion in debt. They got 7.68 billion in EBITDA. No issue there. Trucking right along, we got Target. Target, I feel, is very beat up, especially off of its, was it $260 in August 2021, and then last April it was touching $246 mark. So it's down $133 right now. A recent high of 180. So it's just been trending down. I do feel it's very oversold, my personal opinion. They have a low adjusted free cash flow yield. That's because they had negative free cash flow for the for this year so far. Never like to see that, but it's Target. They've been around forever. They've been increasing their dividend forever and a day. I think that this is just a temporary hiccup, and they're just going to get things right back in order. They have a dividend yield of 3.28%, payout ratio. It's a little high at 70.41%, but again, they're having a rough year so far, which is giving the reason that the decrease in share price has continued. Revenue has been increased at a rate of 8.46% over the last 5 years. Again, that free cash flow yield is negative this year, but if you look, it has been progressing in the right direction. EPS over the last 5 years has been increasing. If you look here, again, if you look at the regression line, it's usually been going up to the right. They just, like I said, they're having a rough year this year. Dividend increases over the last 10 years have been increasing at a rate of 11.82%. They had this really small increase, I think, of 2%. Again, it's just this year's beating them up. They're struggling. But again, I feel like they're just going to get things right back on track. They've been increasing their dividend forever. They are buying back their shares over the last 10 years at a rate of 3.5%, 5 years, 3.3%, and 2 years. Looks like if you look here, they've been increasing the speed. So they've been buying back more and more shares. You like to see that. Good thing. And the return on capital employed usually looks like it hovers around 15 to 20s. Again, this year kind of beating them up. Yeah, I feel it's way oversold in my eyes, and I do like Target for long term. So next up, we got old Nike. Nike, the shoe company in my eyes, just a free cash flow yield of 1.79%. They have a dividend yield of 1.2% and a payout ratio of 37.22%. So Nike is also one that's beaten up a little bit. November of 2021, they were at 177, and then here recently, they're at 124. So again, another stock that's just not been able to catch their footing while everything else is running, or the big seven are running right now. This one's kind of lagging behind. This is kind of like an old reliable. I think I've seen a video where they looked at a 30-year regression line of Nike, and it's just straight up and to the right. So reliable growth over a 30-year time frame. I like, you can't hate on that. Their revenue's been increasing at a rate of 6.32% over the last 10 years, 5% over the last 5. Free cash flow has been increasing at 6.36% over the last 10 years. Again, up and to the right. You like to see that regression. EPS has been increasing at a rate of 26.34% over the last 5 years. Look at that. It's going up and up more, which is very nice. They have more cash than debt on hand. So, I mean, you got your stuff figured out. And if you want a company that's going to be able to handle hard times, find one that has more cash than debt. Like, I don't know. That's such a big check mark. It'd be like a gold star. Just stamp it right there if I could. Dividends been increasing at a rate of 11.2% over the last 5 years, 12% over the last 10. So another really good, reliable compounder. Shares, they've been slowly doing share buybacks. Over the last 10 years, 1.28%. So it is going down slowly but surely. It looks like they haven't bought back shares in a little bit. And the return on capital employed looks like it is around 20%. 2020 hiccup. Pretty much everything has that. But yeah, mid to high 20s, low 20s. Pretty good payout ratio. Anything above 15 I feel is pretty decent. And right around that 20 plus mark is, again, gold star it. And lastly, the only utility company I believe in, this and maybe Xcel Energy, but NextEra Energy, I feel like is if you're going to have a utility, why not have a renewable, like the utility company of the future? They were down from their recent highs this year of $85 down to $73, and with the Feds probably going to stop increasing rates, you don't really know what the Feds are going to be doing, but the second they pause those and start to decrease rates, you're going to see a lot of these companies that rely heavily on debt, I feel, we're going to start running again. And NextEra Energy has been a very great utility for like 20 plus years. They got a dividend yield 2.53%, payout ratio of 51.72%. Very nice. Revenue slowly but surely increasing over the last 10 years, right at 4%. Again, it's a utility. Utilities rely very heavily on debt. As you can see here, they have $55.26 billion in debt. But that's incredibly normal for a utility company. Over the last 10 years, EPS has been increasing at a rate of 3.76%. So a nice little slow but steady regression up and to the right. Their dividend yield's been increasing at a rate of 10.99% over the last 10 years. So a great, reliable compounder. Again, I love compounders. I love companies that have good growth, good dividend history. Love it. This is their share outstanding is going to be going up, and their return on capital employed is going to be a mess because they are a utility company. But utility companies are usually really reliable, especially in times of like recessionary fears. Pretty much anytime utilities aren't a bad idea if you're looking for some safety in your portfolio. But yeah, NextEra Energy down a good little bit. I like it. Yeah, that's everything I've got for you today. Quick look at 5 dividend stocks I feel that you can buy and hold forever and just let compound away. I hope that you enjoyed today's video, and as always, make sure to hit that like and subscribe button for more. And until next time, see yous.